Good morning, executives.
Good morning.
Today we have a special treat. We have our broker, Michael Johnson, to come in and go over the basics of commercial real estate. As you know, he's been working the commercial area for many years, and we're happy for him to share all his knowledge with us. So, without further ado, I want to introduce you to Mr. Michael Johnson.
Thank you, Mr. Gonzalez, my partner in crime here. Thank you so much. What I love to do is, I want to give you an introduction. What we're going to do, we're going to do the commercial series a little bit different than what we've done it in the past. Because in the past, what we've always done was just kind of try to cram everything into one class. So we're going to really take our time. Good morning, how are you? We're going to really take our time and go through what the simple are in the commercial space. So basically the goals of this class is to make sure that you can engage in a conversation with an investor. Because investors kind of talk a total different language. So what I want you to be able to do is to understand what they're looking for, and I also want you to understand basic terminologies that they are using, okay? So we're not going to really get into cap rates as much as we did in the past. What we're going to do, we're going to talk a little bit about what the commercial space is looking like and how we're going to address it. So what is commercial? Commercial is not a single family used as a primary residence. That is not commercial. So pretty much everything else is commercial. You got multifamilies that's 5 and up. You have office buildings. You have residential from 2 to 4. That is considered as commercial multifamily. Retail, industrial, special use, churches, libraries, and things like that are considered commercial. So what is the commonalities between multifamily and commercial? Some of the commonalities is that they're usually held for investment. Okay, people buy commercial properties, they buy multifamily for investment usually. But also they could be owner users. You have people that buy commercial properties that actually use one of the units for actually running a business, and then they use the rest of their property, the income, to help support the business that they run, okay? For example, our business is used for owner user because we actually use this commercial space to actually run our business. So when you're talking to investors, that's maybe something that they may be interested in actually buying commercial to actually run their business and also get the other income. You always have income, expenses, and cash flow. You have depreciation and repairs. You're always going to have that. The methods of evaluation is always going to be your GRM, your cap rates. Sometimes on the 2 to 4 units you got comparables. So you're going to be using that as well. Now commercial is vulnerable to economic changes. So what does that really mean? What that means is sometimes when there's a recession or whatever, it will hit the commercial space. But on the multifamily, I have yet to see it be vulnerable to economic changes. As a matter of fact, I've only seen it get stronger. I was thinking about, because we have a shortage of inventory, right? So I was wondering what was happening with that shortage of inventory and what happened with the multifamily space. But the multifamily space only got stronger. Because in 2008, when we had the crash, the people that couldn't hold on to their properties, they ran to rent. So therefore, the rents have always gone up. I've never seen the rents go down. Now, I've seen real estate go up, I've seen real estate go down, but I've never seen rents go down. So what's really driving commercial, what's really driving multifamily is the rents. So that's why multifamily will probably always hold its value, especially in California. Because as we all know, we're getting ready to experience a change in California from the standpoint of this rent control deal. We don't know which way it's going to go. If it happens to swing in the way of favor of rent control, we're going to have to really keep our eye on the multifamily market because we don't know what's going to happen. So therefore, yeah, it is vulnerable to economic changes, but multifamily is always going to stay pretty strong. What's the benefits of actually commercial and multifamily? It's a very dependable source of income. You're going to have capital appreciation. Now the capital appreciation lately has been anywhere from about 6.4 to about 7.3% over the last 48 years or something like that. So basically, the appreciation has always gone up. Diversification, what does that mean? When you start talking to investors about buying commercial multifamily, you have to figure out what their niche is. See, not everybody likes commercial like the building we're in right now. Some people like multifamilies. Some people do not like multifamilies. They like commercial. Why is that? Well, multifamily usually carries a lower NOI. The reason that it's lower is because you have more expenses that's associated with multifamily versus commercial. Some people love commercial because they love the triple net lease. The triple net lease gives them the opportunity to have a higher NOI. We're going to go through all of this later on in our series, but your conversation with your investors is, what type of investment do you like? Do you like the multifamily space? Do you like the commercial space? Do you like the mixed-use space? What do you like? Very diversified. Do you like a single tenant building? We're going to go over that in our syndication series. We're going to start talking about what is a single tenant building, what is the benefit over a single tenant versus a multi-tenant building. Okay, very stable in value. The reason it's stable is because, like I said, the rents are going up all the time. Okay, now commercial could be a little unstable, especially during a recession, when a property goes dark, which means that it's not filled, could have a challenge. But usually in the market that we're in right now, everything is stabilizing pretty nicely. So you're going to be very stable. Leverage for purchase. What does that mean? Leverage, what does leverage mean anyway? Leverage means I can take a small amount of money and buy a big property. See, what I really love about the United States, even though we have our challenges, the United States has the best banking system in the world. Don't fool yourself. You can't go to some of these other countries and put 3.5% down and buy a property. It ain't gonna happen. It's like, give me 100% of the price and then you can have a property. The banking system in America is the very best in the world. And you should always talk to your investors about using leverage, okay? When people are looking for 2 to 4 units, where else can you find a property that you can buy a $500,000 property with 3.5% down? That is awesome. You should be talking to people about that. Buying properties. I'm working on a commercial deal right now, SBA. Lady can buy a $1.7 million property with 15% down. Come on. That is awesome. You should be talking to people about that every day. Hey, listen, do you know you can do that? The power of leverage. Another thing of leverage is 1031 deferred tax exchange. What does that mean? That means that if you already have a property and if you want to buy more property, you use the 1031 deferred tax exchange. That allows you to not get taxed on that gain and buy even more property. These are the conversations I want you to start having with your investors, with your sphere of influence. There's people in your database right now that doesn't know this. You should be talking to them about it every day. Hey, listen, did you know you could do this? Hey, listen, did you know that we have a 1031 specialist right over here in escrow? And I'm going to have her talk about that too, about what's happening when you exchange. What are the mechanics? How does it work? As a matter of fact, you may be part of the series here. I just thought about it. But it is an excellent way for you to get more knowledge in talking to people, okay? Let's talk a little bit about why commercial, capitalization rates, and things like that. Okay, commercial is the last to get hit and the first to come back. And I'm starting to change my opinion on that. Because when in 2008, multifamily didn't get hit, it got stronger, actually. Because when people was unfortunate and lost their properties, they had to go rent. That's why our rents are sky high right now. So I'm really starting to rethink this. Maybe the commercial space, but the multifamily, I don't think so. It never got hit. It only got stronger. Cap rates. To me, cap rates, the returns are moderate now. I used to say that they're good. They're not good anymore. You know, you have a building that's only giving you 3.5% return, and you have the problems of toilet, termites, and tenants. I'm not sure if that's all that great. Still a good investment, but you know what? You're only at about 2 to 5%. So that's a moderate return to me. It's not a wonderful return. It's a moderate return. The retail is still at about 6.5%. Your office space is about 7%, and your industrial is at about 7%, okay? So I'm looking more at the commercial retail space right now. The reason I'm looking that way is because the return is higher than a multifamily. And we're gonna talk more about that as time goes on through this series. I think what I wanna do, I think I wanna have these series every other week. Okay, kind of let it soak in, then you'll come back. Because we're gonna take our time. We're not gonna be rushing through this particular series. Hopefully next time we'll have Facebook Live going.
It's live.
Oh, it's live? Hey guys, how you doing? I didn't know you were out there. Good to see you. Okay, why commercial syndication? We're gonna have a series on syndication. What is syndication? Syndication is when you get a bunch of investors together in order to buy a bigger property. Now that we're associated with the SEC, we're associated with the 506C, we can actually raise money to do syndications now legally. So I'm extremely excited about that. That's going to help you guys even get more muscle to talk to more investors about doing more deals, okay? So what is capitalization rate? The capitalization rate is actually the way that we come to the value of properties, okay? Can somebody tell me the components of what is needed in determining a capitalization rate? Can anybody give me a component of what it takes to evaluate the cap rate?
NOI.
NOI, very good.
Minus expenses.
Expenses is another one, okay? And of course, we gotta be looking for a price, right? So what is the cap rate? The cap rate is the rate of return that we wanna see on the property. So you should be talking to your investors about cap rates all the time. You can pretty much figure out if an investor knows what they're talking about if they know how to calculate a cap rate, okay? And if they don't, then now you got a conversation that you can start educating them on. The gross rent multiplier. What the gross rent multiplier is that you take the total amount of rent and you multiply it by a certain number and you come up with the price. It's quick, it's semi-accurate, but it's not really accurate. But it's really fast and dirty of how you can actually calculate what a price should be, okay? Now, you have also the gross income multiplier. You have to be kind of careful because what some people out there are doing, instead of taking the rents, they're adding in everything. They're adding in the laundry, they're adding in the parking, they're adding in everything and trying to stick you with a higher price. They call it GIM. So you want to be careful about that and you want to be able to talk to your investors intelligently about that. Okay. Let's talk about now definitions. Okay. The cap rate is the rate of return expected by the investor that's equal to the rates offered by the bank. So what are the rates that's offered by the bank these days? Can anybody tell me? What is the bank giving you? If you give a bank 100,000, how much are they? 1%. And that's good compared to what it's been, right? How much are CDs, Martin?
2%.
2%?
Maybe.
A year, okay. Annual, you know? But here's what it is, they're creeping up. So as the interest rates start creeping up, these cap rates aren't gonna start looking that great. Because if I can just park my money in the bank and get 2%, or if I gotta deal with the headaches of a building and get 2%, which one am I gonna do?
Go to the bank.
I don't go to the bank. Then I don't have to worry about the tenants, I don't worry about the termites, I don't have to worry about changing the toilets, okay? So we're gonna start seeing a change, and I'm very interested to see what's gonna happen with this rent control. Because if rent control swings in the opposite direction, then we're really gonna start seeing a change in the market when it comes to income property. That's
Question.
true. Yes, sir.
So the capitalization rate should be compared to other instruments that are providing interest on an annual basis, such as bank, CDs, or
Yes.
other investments?
That's a great question. Where's the microphone, Martin?
I got it right.
Okay, I'd like you to ask that question so we can, because that's a great question.
The capitalization rate, should it be compared to other financial instruments that are providing interest, such as a bank or CDs or other investments?
That's absolutely right. So when you're talking to your investors, when you're talking to your people, when you're talking to people that has 401ks and stuff like that, is that the correct name, 401ks? Okay.
Yeah.
You should be asking them, hey, listen, what rate of return are you getting on that? Okay? Are you getting a rate of return that's equal to possibly what a property can give you? Because if it's not, because property, the cap rate is not the only thing we look at. We also look at tax write-off, depreciation, we look at appreciation, things like that. So that's a great conversation that you can start with your sphere of influence. Starting getting them to thinking, you know what, is my money parked really in the right instrument? Okay, because real estate will always be a great investment. It's just the right piece of real estate. Gross rent multiplier, the value of the property will measure by how many times of the annual rent, okay? We'll get more into that when it's time to do the numbers. So here's what's interesting, and this is a great conversation when you have with your investors. When you're a buyer, you want a high cap rate, right? The reason you want a high cap rate is just like when you put your money into the bank, into a savings, you want a high interest rate, right? Okay, that's when you're a buyer. But when you're a seller, what do you want?
The opposite.
You want your low cap rate. You want a very, very low cap rate. You don't want a high cap rate because the higher the cap rate, the lower the price, okay? So let's do a little math right here, off the top of our heads. If I have an income of $100,000 and if I have a cap rate of 10, then how much is the price of the property going to be?
110?
No. Listen to it, if my income is 100,000 and I want a cap rate of 10%, then what should the selling price be? $1 million. Who said $1 million?
Sean,
John. Okay, you get a chocolate next time I talk to you. Okay, all right. So look how this works. If it's 10%, if the cap is 10, and the income is 100,000, the property is $1 million. Now let's go down just one digit. Let's go down to 9. I still got my same $100,000 income, but now my cap rate is 9. How much is the property going to be worth?
100.
No. Nope. Who has a calculator?
It's 100,000?
is 100,000,
100,000 income,
okay, divided by what?
9%.
Is 1.111.
That's right. Look at that. If it went down 1 and the price jumped up $100,000. Now this is when it gets interesting to your investors, because if you buy a property and if you buy a 10 cap rate and if you could just drop that cap rate by 1, you just made yourself $100,000. That could be done overnight. That could be done overnight. And that's what we're going to get into. So thank you very much, Martine, for that. All right, formulas. Let's talk about the formulas that's going to be needed. We're not going to get into the numbers today, but what we're going to do, we're going to talk about the formulas. I want you to get this in your spirit so that when you start talking to people, then you can know what you're speaking about. So let's talk about we're at the gross rent multiplier, okay, the annual rent times the GRM, that's what that is, okay. Capitalization rate, okay. So the gross rent multiplier is the annual rents times the amount of the number. So if we have 100,000, right? And so let me explain this so that you'll be very clear on what GRM is all about. Every area that people invest in, the gross rent multiplier number is going to be different. The higher the number, the better the area. The lower the number, it becomes more of a bread and butter area. So let's say that you have a low GRM of 6 to 8. That's basically what we call the bread and butter areas, okay? Or either some of the more riskier areas. If you have a higher GRM, if it's 15 to 24, if you're in 24, you're in Beverly Hills, you're in Newport Beach, you're in some of the very higher areas, okay? So therefore, when you start talking about GRM, you gotta know the number of that area, and we'll determine that number as we get deeper into our analysis of the properties. But I'm just gonna use a gross rent multiplier of 10, okay? So if I have, and don't confuse the GRM with the cap rate. It's totally different. The GRM is totally different from the cap rate. I'm just using 10 as an example. So if my GRM is 10 and my income is 100,000, then what is the price? A million. Very good. If it's 12 and my income is 100, what is the price? 1.2. Very good. It's a quick and dirty way to determine the value of a property. It's not accurate, but if you're talking to an investor, and this is how it's going to help you. If you're talking to an investor, say, Virginia, how much is my property worth? If you know the area where the property is, then you just say, well, Mr. Investor, how much is your gross income? Well, my gross income is $50,000. Okay. And you're at a 10 GRM, your property's worth about $500,000. So you see how quickly I did that? Then my next follow-up statement is, but you know what, if you really want me to get you accurate, let's sit down, let's have a conversation, let's make an appointment, and let me get all the information I really need, and I can really be accurate. What time would you be available, or what day you would be available? That's a conversation that you can quickly have, okay? And we're gonna teach you all of that when we get to our numbers. How do we get to the capitalization rate? Well, we have to know a few things. We need to know what is the total operating income, okay? We need to know what are the expenses. Now, usually what the bank is going to ask you for, the bank is going to ask you for 30 to 35% of the total operating income. Even though it may not be that, if you're going to get a loan, that's what they're going to ask you for, okay? You're going to need to know the net operating income, and you're going to need to know the price. And we're going to figure that out a little bit later on. All right, is everybody with me so far? Very good. Okay, the terminology for the valuations. What are the terminologies? The terminologies is a gross scheduled income. What that is all the rents that are coming in annually. We're going to need to know that for our calculation, okay? We're going to need to know the vacancy factor. Now, what is vacancy factor? Anybody?
Number of months that the property is vacant.
Number of months the property is vacant, absolutely. So what happens if my property is never vacant?
Vacancy factor is zero.
Vacancy rate.
Okay, if my property is never vacant, that means the vacancy rate is what?
Zero.
Zero. But if the bank, thank you, Martin. But as far as the bank goes, what does the bank think about that?
They still will consider a minimum.
They still consider the vacancy factor. I don't care if your property is rented 100% of the time, all the time. What is the vacancy factor in California?
5%.
About 5%. So whenever you're going to start analyzing properties, you're going to always say it's about 5%. Okay? All right. Let's go ahead and go down to economic vacancy factor on your sheets. What the economic vacancy factor is the factor of if you give concessions for your unit. Let's say, for example, I have a unit that's hard to rent. So I'm going to say, okay, I'm going to give 1 month free rent or 2 months free rent. That's called economic vacancy factor. Does that play into the price? It absolutely does. It absolutely does, okay? So we're gonna have to be careful of that. Net rental income. What the net rental income is the amount of income that you're gonna have when you take away the vacancy factor and the economic vacancy factor. Then you're gonna have the net rental income. Other income is other income such as parking, laundry, garages, billboards, things like that, okay? Which gives you your total operating income, all right? Then you have your operating expense, which we categorize as tummy. Tummy is is what we use for our operating expense, which gives us our NOI, all right? So we're going to be able to go through this on our second go around to actually look at the numbers and see how the numbers gel together and come together, okay? So we're gonna talk about the calculator real quick here. Give me a second to get back online. Okay, now as you look at your calculator, this is a really quick and easy way in order to calculate what you're looking for. The only thing you have to do is put your finger over what you're looking for, and it will, give me 1 second here so I can get back online. There we are. What it'll do is, like, whenever you're looking for a price, if you have your NOI, if you cover the price, if you have NOI, if you have a cap rate, if you cover the price and you know what you need to do, you need to divide the cap rate into the NOI to get the price. That was the example that we just did. Okay? If I don't have the NOI, if I don't have the income, I will multiply the price by the cap rate and it will give me the income I would need. So this is a pretty nifty tool, and I will certainly use it to your advantage. Okay? Let's move on. Let's talk about the investment analysis software. Because I want to go over this, because I want to make sure you guys have this so that you know. What the analysis software does is an instrument in order to make sure that we can have a report so that we can talk intelligently to our consumer. Okay? Because you can talk all day, but when the consumer actually sees the numbers on paper, then it becomes a whole different story, okay? It's used to set up a pro forma. And what is a pro forma? What a pro forma is, whenever you list an investment property, you want to have a sheet that you can share with other investors and other real estate professionals to show them what the numbers are, okay? It gives them the opportunity to actually see what the return on investment is, what the cap rate is, and all of that stuff. Now, when you work for Realty Executives All Cities, commercial, we actually provide a software for you that will give you the opportunity to do this. You don't have to pay for it, it's free, and we will show you how to use it, okay? So, what type of properties should I use this for? Well, I should use it for multifamily, number one. I should use it for commercial. You can use it for special use. You can use it for multiple single-family residences. Some investors like to buy multiple properties at one time. They bought 5 and 10 single families at one time. Okay, you can show them what the return on investment is. Duplexes and triplexes, not so much, because basically you're using the comp for that, okay? And it starts with 4 units and up. So what I'm going to do quickly now is actually go to a property that we have, and I want to analyze it. This is a property that I actually did a presentation on. It's a property that's in Las Vegas, okay? And this property is really a cool property because number one, it's a commercial property. Number two, the numbers on it really look good. And I'm going to kind of go through the program to show you quickly how to read the numbers, okay? Now, we had a class on this before. I'm not going to go too much over it again, but that's the general tab there to where you can fill in all your information. As you can see, you got resale and all that great stuff, and you can put in a lot of your general information here. You want to put in your financials, okay? Marisol, can you make sure that the camera is zoomed in on the screen? Because I won't be in front of the screen too much anymore. Your financials, you can put your financials in there. You can make sure that you have your mortgage information in there. You have your interest rate in there. You got your federal tax in there. All of this great stuff right here. You want to make sure that all of it's there so that you can actually get a correct report. You can put in your income, okay? And the great part about this software is that if you don't know the income of each unit, you can just put in the total monthly income, the annual increase, the annual vacancy, and it will automatically give you a number. So that's an awesome part about this particular software. You can do the same thing with the expenses. If you don't know what the expenses are, right here, you put in your actual expenses, and it will give you the number in order to give you what you want. So I want to focus in on the actual reports that you're gonna need to talk intelligently to your, now this was an actual pro forma that I put together. It talked about the actual property. Let me see if I can blow this up here. Okay, it actually talked about the property. So in your pro forma, what you want to do, when you actually put a pro forma together, you want to give the highlights of the property. For example, this had a cap rate of 7.15. Real nice. Rate of return of 13%. Profit over 5 years was 1.7 million. So when you start putting a pro forma together like this is what you want. This is the cover sheet. You want to show your investor up front, hey, this is what I'm offering you. This is great for syndication. 2 or 3 or 4 people that have this type of muscle that can put together and buy this property. You want to talk about the demographics. This one, the population is over 175,000. I think this is in North Las Vegas or something like that. Excellent visibility, things of that sort, okay? So let's go to the investment details quickly. The investment details, you should always talk about what the purchase price is, 6.5 million, what the down payment is, and what your closing costs are, okay? Because that's part of the actual pro forma of showing your investors, this is what it's gonna take in order to pull this property off. Then you should talk about your gross operating income. This, in this particular case, is 619,000, and the annual expenses is 155,000. So I'm gonna just focus on one more report for you before we wrap this up. And this is what we call the actual executive summary. And this summary kind of tells the big picture of what you have. It shows what the purchase price is in the closing costs in its totality. Okay, and what it was, and how much cash is needed. So in order to put this investment together, we would need $2,275,000. Okay, we have a first loan of $4 million, and 550,000. Okay, the purchase price was 6.5%. These are the numbers that we're gonna start looking at and start really focusing on. What is the cash on cash return before taxes? Because that's what the investor is really interested in. If I put in my money, how much is gonna be my cash on cash return? In this case, it's 7.53%. Is that pretty good? That's not bad at all.
Better than the bank.
It's better than a bank, it's better than a lot of CDs, it's better than a lot of stocks.
Stocks.
Okay. See, the thing about real estate versus stock is what? I can live in the real estate. I can use the real estate for utility. For the stock, well,
Up and down.
I can wash my windows with the certificates maybe. You know, things like that. But I can't live in a stock. Is that right, Mr. Gonzalez?
The other important thing is if the stock value drops, you know, your income drops as well. And on real estate, it doesn't. You still receive the same amount of rent.
I love that. Anybody hear that?
Oh, yeah.
That's a great one. When the stock drops, the income drops.
Yeah, or CDs, whatever.
But when the real estate drops, the rents don't drop. You know, when I was renting, I've never had anyone say, hey, Mr. Johnson, I know it's really a bad time, we're gonna drop your rent. I never heard that. Okay, so that's a great deal too. Let's see what else we have here. We have debt coverage ratio of 1.58. Is that good or bad? That's great, because what the bank looks for is 1.25. So, will the bank buy this deal? Oh, yeah. Capitalization rate, 7.15. Very good. I like that, okay? The income per square feet, the gross expenses per square feet, and the operating expense ratio, 25%. Pretty nice, pretty nice. Now, what we're gonna find as we go through our studies is that 25% for commercial is about the norm. Why is that? The reason that is because basically the tenants in a triple net lease pays for the majority of the expense. That's why investors love commercial property.
That's the expense against the income, right?
Exactly. Now, if this was a multifamily, that number may be 30, 35, 40%. All right? Because you have to carry the expense, right? You gotta pay the water, you gotta pay all of that, you gotta pay the taxes. In triple net lease, the commercial tenant pays all of that, which we're gonna get into even more. It's gonna be awesome once we really break it down, you're gonna be excited about it, okay? So basically, that's gonna be the, and I'll do one more. We're gonna do the financial indicators. That's gonna show us basically the big picture of what we have. Okay, so we have the gross rent multiplier of 10. We have a cap rate of 7.15, cash on cash return 7.53, debt coverage ratio 1.58, and our loan to value on this is 66.89, basically 70% loan to value. Okay?
Do
All right.
you typically go out 5 years and then just have the increasing factors such as?
You have the microphone?
Do you typically go out 5 years and just increase the rents and income based on the factor in your presentation?
Exactly, we do. We usually use 5 years, we usually use 3 to 5% increase, and we also do the same thing for the expenses. Exactly. Okay. Any other questions? Did you guys get something out of this today? Good,
Yes.
good, absolutely. So on our next session, what we're gonna do, we're actually gonna start digging into the numbers, okay? These sessions are probably go maybe for about 8 weeks, every other week. We're gonna bring in a lender that talks about commercial lending. We're gonna talk about syndication. We're gonna talk about asset protection. We're gonna talk about tax savings. And we're just gonna do more of the analysis. If you guys have any properties you want us to help analyze, that would be great. Bring it to the table. Gonzalez, Roberto, if you have anything, please bring it to the table so that we can analyze these properties live in living colors. It'll be really easy. And we'll be good to go. So, hey guys, out on Facebook land, thank you so much. If you're interested in joining our company, Realty Executives All Cities, please contact us. We'll be more than happy to sit down and talk to you. It's an awesome company to work for. And thank you so much, and we'll be looking for you next week.
Okay, here we go.
All right, that's it. Have a good one.
I have a quick announcement.